Hello friends, how are you? Welcome to the second session of chapter Partnership, the Fundamentals. I hope you have gone through my earlier video, which was the first session. If not, please take time to see it. The link is given in the description. First thing first, this is a session where we will work with numbers and ledgers. So please keep yourself handy with a notebook or a register, a pen, and a ruler or a scale before you start the session. Now let's start with a quick recap of our last session. We started with the definition of partnership given under the Indian Partnership Act 1932, and I asked you to learn it word by word. I hope you have done that. Remember, it's easy marks if you want. I covered the 5 points under characteristics of partnership. Then we discussed the concept of partnership not being a separate legal entity and the legalities of it. The rights that partners have in their partnership firm, consisting of 9 points. We discussed agreement and partnership deed, its definition, why is it recommended, clauses that it covers, and the implications of its absence. We also broadly discussed the concepts of charge against profit and appropriation of profit, and we will further understand these topics with some practical problems today. So welcome to the second session of the chapter. I suggest today you keep a register, a pen, and a scale ready. This is going to be a very interesting session and a very important one too. We will learn what is and how to prepare the profit appropriation account. Please keep a register ready today. I hope that by the end of this session you will find it quite easy to make the appropriation account. Hi, this is Amit Lawania. Welcome you again to the session. Let's dive. Now before starting to get into the numbers and ledgers, we must understand what a profit appropriation account is and when and why is it prepared. Now the net profits of a firm belong to the owners, which is partners in this case. Since there are 2 or more persons in the partnership firm, these profits are required to be distributed. The profit appropriation account is prepared precisely to do this. That is, to distribute the profit or loss among the partners as per the agreed terms. If you could understand the characteristics of profit appropriation account, it will form the basis for handling the practical questions and make it easier to solve them. You don't have to note these down, just keep your minds open and try to understand the points that I will make. First, do not confuse profit appropriation account with a profit and loss account. They are different. Profit appropriation account is prepared after the profit and loss account to distribute the available profit among the partners. So we get profit from P&L account. When we distribute this profit, we make a profit appropriation account. Now the clauses and terms of agreement come into play in a big way when making the profit appropriation account. The profit is distributed to the partners as per these very terms that are provided in the agreement. In case the agreement doesn't cover any issues, the provisions of Indian Partnership Act 1932 will apply. I hope you remember this from session 1. If you don't, please go through my last video again. The link is given in the description. Now the structure of profit appropriation account is the same as any other ledger account, having a debit side and a credit side, dates, particulars, amounts, and totals. It is all very similar. Appropriation is done out of profit of the firm, but there are expenses that are payable to partners even if the firm is not in profit. These are said to be charged against profit. We get a profit or loss from P&L account. Charges against profit are deducted from this profit to get the profit that is available for appropriation, which is then distributed among the partners. A quick tip here: remember to always deduct charges against profit first. Rent to partner and interest on loan by partner are the two expenses that come under the heading of charges against profits. There may be other deductions that you may have to consider as per the case, but in most questions, whenever you see rent to partner or interest on loan by partner, deduct them first. Now, preparing a profit appropriation account can be a lengthy affair, and various teachers may have different approaches for it. But I personally like to follow the method of 4 boxes that reduces the probability of making a mistake. Here, the numbers and details go through 4 processes that I like to call boxes, and the results from each box help us make the profit appropriation account without making any mistakes. So these 4 boxes help you reduce the chances of making a mistake. Let's have a look at the boxes. First box, to get profit for appropriation. In this box, we deduct all the non-partner expenses and charges against profits from the net profit brought from the P&L account. And what do we get from this box? Profit for appropriation. Second box is for calculating the appropriations, that is, the amount to be distributed among partners as per the terms of their agreement. The clauses of agreement are calculated and arranged here. What do we want from this box? Total amount required by partners in the form of interests, salaries, and commissions from the distributable profit, or in simple words, total appropriations desired as per the agreement. Now, once we have results from box 1 and box 2, we go to box 3. This is where we compare the results of box 1, that is profit for appropriation, and box 2, that is total appropriations. This box helps us determine whether the profit sharing ratio given under the agreement will be followed or not. Are you confused? Just wait for the examples that I will show in a while, and this will be the easiest box you will find. Anyways, finally, we arrive at box number 4, and not empty-handed. We have the outputs from the 3 boxes to help us. We put all those 3 outputs in this box and transfer the profit to the partners in accordance with the agreement. Now, these 4 boxes and the terms used may look tedious or maybe even complicated, but they are not. By the time this video ends, you will be well equipped to prepare the profit appropriation account with ease. I will now quickly provide the format of each box with the help of a couple of questions. Start making notes. I would suggest that you keep your register, pen and scale ready to note down the formats. We begin with the first case or question to understand the concepts of these four boxes. Case 1. Please note down this question as I read it. We will take the items from it, fix them in the boxes and get the answers. X, Y and Z are partners in a firm. They have invested capitals of rupees 80,000, rupees 60,000 and rupees 40,000 respectively. They withdrew rupees 20,000 each during the year. The profit sharing ratio is agreed at 2:2:1 for X, Y and Z. X had also given a loan of 50,000 at the start of the year. The partnership deed provided for interest on capital at 5% per annum and interest on drawings at 10% per annum. The agreement also allowed a salary of rupees 1,000 per month to Y and 10% commission on profit to Z. Profit before interest on loan. The firm earned a profit of rupees 40,000 during the year. You are required to make the profit appropriation account and distribute the profits as per the agreement. Pause the video if you require more time to note down the question. You will have to refer to it as I provide the solution. Box 1 is to find the profit for appropriation. That is the profit available for distribution among partners. We start with the profit that we got from P&L account. It is given in the question to be rupees 40,000, which we write in the last column. Then we look for charges against profit, which are rent to partner or interest on loan by partner. In this question, we see that X has given a loan of rupees 50,000. Since there is nothing given regarding the interest on loan, we will apply interest at a rate of 6% per annum, which is as per the Indian Partnership Act 1932. The question also mentions that the loan was given at the start of the year, so interest will be payable for all 12 months. We get the amount as rupees 3,000, which we put in the last column. Now we look for any expenses which are not related to partners or any adjustments required to be made to the P&L account, and we find there are no such expenses given in the question. So we subtract the amount of charges against profit from the profit to get the profit for appropriation, which is rupees 37,000. We have now gotten our desired output from box 1, which is the amount of profit for appropriation. To remember a few very important points here before you go to the next box. Number 1, identify all the charges against profit and deduct them from profit in this box. Number 2, deduct all the non-partner expenses in this box. Number 3, none of the above two expenses go beyond this box. The charges against profit and non-partner charges do not go beyond this box. From next box, we will work with the items related only and only with the partners, that is, the owners of the firm. The steps in this box are simple. I hope you have understood them. Please rewind if you have any doubts. See again the calculations and listen carefully to the points I spoke. Do not forget to keep making notes. Now, we shall put all the values relating to the partners in our box 2, which is the table of appropriation. The table will tell us the amount of adjustments to be made from profit for the partners as per the clauses of their agreement. This table can have many entries, so it may take a little more time, but on the other hand, it is easy to prepare. In addition, it helps us put every detail in the right place, which will reduce the chances of making a mistake. Note down the format, please. We still start with drawing the table, particulars in the column 1, where we will write the items from agreement, totals in column 2, where we will put the totals for each item, followed by the columns for each partner. Now we will start putting numbers in this format, which will make the concept clearer. Please be attentive and focus on the steps. This table is easy to make, but it takes a bit of time. Also, it will be very useful when we start making the profit appropriation account. Refer to the question and keep noting. Now from the question, we write the capitals first. For X, rupees 80,000. Similarly for Y, rupees 60,000, and for Z, rupees 40,000. This is the capital invested by each partner. Next, we put the total in the totals column. Then we write the amounts for drawings in the same manner. Rupees 20,000 for each partner. This is given in the question, so we just need to copy them in the table. Then we write down the total of the drawings. Next, we write down the sharing ratio for each partner. This is written as fractions. The ratio was 2:2:1. So fractions become 2/5, 2/5, and 1/5 for each partner. The total of profit sharing ratio should always be 1. If it is not 1, you must have done an error somewhere. Now these are the amounts that are not related to the profits, meaning that they are neither added or subtracted from the profits. So we draw a line and now write down the adjustments that are made against the profit for appropriation. Number 1 is the interest on capital being allowed at 5%. This is calculated on the capitals that we just noted in the above row. For partner A, interest is 5% of 80,000, which is rupees 4,000. For B, it is 5% of 60,000, which is rupees 3,000. And for C, it is 5% of 40,000, so rupees 2,000. Do not forget to write down the total of interests, which is rupees 9,000 in this case. Next item we find in the question is salary to partner Y at rupees 1,000 per month. So for the year, that is for 12 months, it will be rupees 12,000. No salaries for the other partners, so the total salary will be rupees 12,000. Similarly, a provision for commission at 10% on profit is mentioned for partner Z. So we calculate 10% of 40,000, which is profit, and write down the amount of rupees 4,000 in the Z's column. Also, since there is no commission for other partners, the total of commission is rupees 4,000 only. Next, we find a clause on interest on drawings at 10%. Since no date of drawings is given, it is considered that the drawings were made uniformly throughout the year. To put it in short, if the date is not given for drawings, the interest is calculated for 6 months only. So the interest will be rupees 20,000 into 10%, which is 10 by 100, into 6 by 12, and we get the answers as rupees 1,000 for each partner. You would note that the amount of drawings is written as negative number because when all the above adjustments, that is interest on capital, salary to partners and commission to partners, these are paid to the partners, whereas interest on drawing is paid by the partners. Now that we have noted all the items, all we need to do is write down the totals for each column. For totals and for each partner, write down the totals here. So from box 2 we have now got the output we wanted, which is the total amount of appropriations required by the partners, and rupees 22,000, which is the grand total, is the amount that we need from this box to carry to the next one. Now on to the box 3. This is the box for comparison. From this box we will decide the profit sharing ratio that will be applicable when we make profit appropriation account. So now we have two results: the profit of appropriation from box 1 and total appropriations from box 2. We compare them to find out which one is greater. It is the profit from appropriation from box 1 that is greater at 37,000 rupees. Now this box has 3 scenarios from which we will choose the scenario which is suitable and apply the profit sharing ratio accordingly. The scenarios are here. Number 1, when profit for appropriation is greater than total appropriations. If that is the case, then profit sharing ratio will be applied as per agreement. But in case total appropriations are greater than profit for appropriation, that is the second scenario, we use a new sharing ratio, for which we will have to go back to box 2 and check the totals of appropriation for each partner. These totals will then become the new sharing ratio. Remember, this is when appropriations are greater than the profit. And there could be a third scenario where we get loss from box 1. That is, the box where we get the profit appropriation, it shows a negative value. In this case, no benefits to the partners are entertained. Only the items on the credit side, that is interest on drawings or any transfers from reserve, they will be posted in the credit side of partnership appropriation account. Nothing will come on the debit side, that is no payments will be made to the partners in case of loss. But since we found that the profit for appropriations are greater than total appropriations required by the partners, we select scenario 1, which means that the original profit sharing ratio as given in the agreement and our question will be used. So we have now got our desired output from this box, the profit sharing ratio, which in the question is 2:2:1. Now we get to the final box, the profit appropriation account. We have arrived at the ledger account that will get us full marks in the exams. The account is prepared as any other ledger account. So we start by drawing the lines and format first. Debit side on the left, credit side on the right. Wait. Here is a tip. Before you start making the account, follow this little tip. Any amount that reduces the distributable profit, put it on the debit side on the left, and any amount that adds to the distributable profit among partners, write it on the credit side on the right. So now back to the ledger. Write date, particulars, amount, and same on the credit side. The format is now ready. So let's start putting the figures. Remember to always start with the date. The first thing we put on the profit appropriation account is the profit or loss that we get from box 1. This is the profit available for appropriation among partners. Rupees 37,000 in this case. Next, all adjustments will be taken from box 2, like the interest on drawings. Write down the breakup for each partner and the total. Rupees 3,000 in this case. This has come from box 2. Now, going to the debit side. Always start with the date. We start by putting the interest on capitals, their breakup for each partner, and the total amount. Again from box 2. Write down the salary to partner Y at rupees 12,000. Z's commission at rupees 4,000. All figures now coming from box 2. Now that's it. All the entries have been made now. No point or item is left. So we can go ahead with the totals. But before that, a couple of points. Observe that the profit here came from box 1 and the adjustments for partners came from box 2. Since we had done the calculations already, we only had to write them here. Very easy. Also note that all the entries in this account are concerning the partners only. No outside person or expense can be seen here. All the adjustments regarding the outside persons are done in profit and loss account, or they are taken care of in box 1. So let's do the totals. Credit side is greater, so first the total of this side, rupees 40,000. We copy the same on the debit side, rupees 40,000. Now on the rough sheet, calculate the total of debit items. It comes out to be rupees 25,000. That is 12,000 plus 9,000 plus 4,000 comes out to be rupees 25,000. By this we come to the balancing a figure which is rupees 15,000. This is the excess profit left over and above the appropriations as per the agreement. What do we do with this profit? We divide it among the partners in the profit sharing ratio which we got from box 3. 2:2:1. So the profit is now transferred to partners' capital accounts. Hope the concept is clear now. I would recommend practicing the question once again. More practice means better marks. Now in the previous question, we saw a situation where profits available for appropriations were enough to meet the appropriations required by the partners. It is time to take up a problem where the profit available for appropriations are not enough or are less than the total amount of appropriations. Here is the case 2. Please start noting this as I read the question. A and B are partners sharing profits and losses in the ratio of 2:1. A has invested an amount of rupees 10 lakh as capital. He also gets a rent of rupees 10,000 per annum. The partnership deed provides for interest on capital at 7% per annum. It also allows a salary to be at rupees 5,000 per month and commission of 10% on profit. Net profit before above adjustments is rupees 1,10,000 for the year ending 31st March 2020. Show the distribution of profit. Pause the video if you have not noted the question as yet. You know where we start from? Box 1, the box for profit for appropriation. Start putting the numbers here. Profit from P&L account given in the question as rupees 1,10,000. Next, look for charges against profit, which is rent at rupees 10,000. Non-partner expenses are not there, so we deduct the amount from profit and get our profit for appropriation of rupees 1 lakh. Now we have the desired result from box 1. Rupees 1 lakh is the profit available to partners for appropriation. Off to box 2. Then, to get our amount of total appropriations, start making the table just like the last time. Column 1 for particulars, column 2 for totals, column 3 and 4 for the two partners in this case. Now, let us put the items that are unrelated to appropriation of profit, starting with capitals of the partner. Rupees 10 lakhs by partner A and 0 by partner B. So the total will be rupees 10 lakhs. No other such item mentioned in the question. So we need to note down the profit sharing ratio for each partner in the form of fraction. 2:1 is the ratio, so the ratio is written as 2/3 and 1/3. Total of profit sharing ratio is 1, so all is well. Now the items for adjustments. Interest on capital. A gets 7% on capital, so rupees 70,000. No capital for B, so no interest on capital too. Total amount will be rupees 70,000. We see that there is a provision for salary to partner B at rupees 5,000 per month. So for the full year, the salary will be 60,000 rupees, which is also the total salary payable to the partners. Partner B also gets commission of 10% on profit after rent. So we take the profit after deducting the rent payable to partner, which is rupees 1 lakh, and provide for a commission of rupees 10,000, that is at 10% per annum to B. Again, we put the same amount in the total also. Once we have noted all the adjustments for partners, it is time to write down the totals. Rupees 1,40,000 as grand total of the columns that reflected the totals. for the columns of each partner, the total comes to rupees 70,000 each. This time it is the same for both the partners. We now take our desired output, the grand total, to box 3 for comparison. Friends, it is time for the bout. On the left we have the profit for appropriation at rupees 1 lakh coming from box 1. On the right we have the total appropriations desired by the partners at rupees 1,40,000 from our box 2. So who wins this one? Which one is greater? This time it is total appropriations from box 2 which is greater. Let's head to the scenarios to decide the profit sharing ratio. There are 3 scenarios, but this time scenario 2 will be applicable, and the sharing ratio will be the totals of the partners' adjustments in box 2. So we go to the box 2 once again and check the new profit sharing ratio. Now here is the box we made earlier. Remember, the profits are not enough to meet the appropriations amount this time. So the agreed profit sharing ratio is not applicable. But the totals of the appropriations become the new sharing ratio, which is 70,000 for partner A to 70,000 for partner B. Since the amounts are equal for both partners, the ratio for sharing profit will be equal as well. So we now have the output as equal profit sharing ratio. Now we start making the profit appropriation account with the new sharing ratio. Start with the lines debit, credit, date, particulars, amount. Same on the credit side. Date is the first entry we put, and we bring the profit from profit for appropriation box, that is box number 1, rupees 1 lakh. No interest on drawings this time, so we go straight to debit side. Date first, and since the profits are inadequate to meet the appropriation, no entries on credit side will be posted. We will go to the totals straight away, first on the credit side, then on the debit side, and distribute the full amount among the partners as per the new ratio, which was equal profit sharing ratio that we calculated on the basis of totals of partners in box 2. So each partner gets rupees 50,000. So now we have done 2 questions, one where profit for appropriations were adequate, and second when the profit available for appropriations were not enough to meet the total appropriations for partners. The third case. In case of firm making a loss, or if we get a loss from box 1, that is, we get a negative figure from box 1, no adjustments will be allowed on debit side. Only entries on the credit side of the profit appropriation account will be entered. Losses will be shared on the basis of agreement, the ratio given in the agreement. Share of loss will be transferred to partner's capital or current account as per the case. You are now equipped to make a profit appropriation account. If you follow my 4-box approach, you will be able to make profit appropriation account for any given problem. We have studied 3 situations for it. We got situation 1 where profit available for appropriations, that is output from box 1, was more than appropriations, that is output from box 2. Then in the second situation, we saw that profit of appropriation were inadequate, leading us to use a new ratio, which we got from box 2. And third, when the firm was running in loss. Easy to make the profit appropriation account. Just post entries on credit side and distribute among partners as per the agreement profit sharing ratio. Now a quick recap of boxes. Box 1 gave us profit available for appropriation. Box 2, we get the total appropriations required to meet the clauses of agreement. Box 3, we compare the outputs of box 1 and box 2 to determine the profit or loss sharing ratio. Box 4 is the profit and loss appropriation account itself, where the actual distribution of profit or loss is done to the partners' capital or current accounts. Now in our next session, we will dive deeper to explore the various parts of profit appropriation account, 4 of the important ones, how they are calculated in various scenarios, and how they will be filled up into the box number 2. All of this in the coming sessions. Stay tuned, subscribe the channel and hit the bell icon if you wish to receive updates. Hope this session was helpful to you. This will be the end of the session 2. This is Amit Lawania saying goodbye. Oh yes, a couple of questions follow that you should practice. Keep practicing. Practice makes perfect.